Welcome to the deep dive. Today, we are taking on a deep dive into one of the most, I think, critical and complex stories in the modern technology landscape. CyberArk software, ticker CYBR.
It's a fascinating one.
And for you, the discerning and critical investor, this isn't just another security company. It's a strategic asset. It has defined an entire category.
A foundational asset.
Exactly. And it's currently valued at, what is it, around $25 billion in this huge pending acquisition by Palo Alto Networks, or PANW. This is one of the largest strategic deals in the history of cybersecurity.
It's massive.
So our mission today is to move beyond the headlines. We are going to evaluate the durability of the company's wide economic moat, that competitive fortress they've built, and really unpack the sophisticated financial and strategic implications of this merger.
Right. This is about understanding the fundamental architectural shift that's happened in security.
And why CyberArk? Well, why it truly holds the keys to the future digital kingdom.
That really is the crux of it. When our sources evaluate CyberArk, the verdict is just. It's robust and it's unanimous. This is a premium, wide economic moat asset.
And that moat isn't just marketing fluff.
Oh, not at all. It's not built on wishful thinking. It's validated by years of implementation that create exceptionally high customer switching costs, which I know we'll get into, and critically, their successful pivot.
The move away from that lumpy revenue.
Exactly. Away from those volatile, unpredictable license streams to a really high visibility subscription model.
So the current situation, it's intriguing. It offers, what, two different opportunities?
I'd say so. On one hand, it functions as a highly compelling merger arbitrage vehicle. It's a relatively safe trade, where the downside is heavily protected by strong, demonstrable standalone fundamentals.
We'll definitely dig into that protection later.
But more importantly, I think, for the long-term holder, this acquisition forces you to evaluate whether CyberArk's tech, now inside the PANW behemoth, forms the basis of the next dominant security superplatform.
So the strategic value being purchased here is, it far outweighs the immediate financial spread.
That's the thesis.
Okay, let's unpack this, starting with the strategic foundation. I want to challenge the premise a little bit. We hear digital transformation all the time, but why did the traditional security model not just get a little dusty? Why did it fundamentally collapse? Why did identity have to become the new perimeter?
A collapse you're talking about, it's really rooted in physics and geography, if you think about it.
How so?
Well, for 40 years, the security paradigm was the castle and moat architecture. It was simple. The crown jewels, the precious data, it all lived securely inside the company's own on-premise data centers.
So you built walls around it, firewall.
Precisely. And that system was logical. It was mostly effective because you could clearly, and I mean clearly, define the inside and the outside.
And then the cloud happened. And then hybrid infrastructure, then hundreds of SaaS apps, then remote work, and suddenly the castle wall just vanished.
It completely dissolved. The data is now, it's all over the place. It's geographically fragmented. It's not in one building anymore.
It's in Amazon Web Services. It's in Microsoft Azure.
It's in Google Cloud. It lives in hundreds of fragmented software as a service apps like Salesforce and Workday. And the people accessing it, they're at home on their own networks.
So the firewall-centric model, it just can't account for that kind of fragmentation. You can't put a moat around an environment that's designed to be borderless.
You literally can't.
So if the data is everywhere and the physical barrier is useless, what's left? What's the one constant control point that security teams can actually grab onto and enforce?
The access token. It's identity. The combination of a user's credentials and their specific set of permissions. That becomes the only ubiquitous control point that is truly independent of location.
And CyberArk's whole business, their core competency is privileged access management, or PM.
Which secures the most critical part of that identity landscape. Think of PM as securing the physical keys and the master blueprints to the entire kingdom.
The godlike access.
Godlike access. These are the the super user credentials that grant unrestricted, total access to the most sensitive data and infrastructure.
And securing those master keys is the foundational element of this industry-wide philosophical shift towards zero trust architecture, isn't it?
It is.
But critics often argue zero trust is, just an aspirational marketing term. How does CyberArk prove ZTA is a tangible, measurable security investment?
And that's a totally fair challenge. ZTA, or the Zero Trust Mandate, it fundamentally shifts security. It's no longer about trusting based on location, being inside the network.
Right, the old model.
It's about continuous authentication. Who are you What are you trying to access and why do you need it right now? It mandates distrust of all users and devices no matter where they are,
So trust nothing, verify everything.
by default.
Yeah.
And CyberArk's platform is what operationalizes that concept. You just can't implement zero trust effectively if you don't control the ultimate access accounts, the privileged ones.
Because if an attacker compromises one of those,
Your whole ZTA model just collapses instantly. They just bypass all your controls. So by securing those high-risk accounts with controls like session recording, just-in-time access, detailed logging,
all the granular stuff.
all of it, by doing that, CyberArk moves ZTA from a concept on a PowerPoint slide to a measurable reduction in your actual risk.
Okay, here's where it gets really fascinating for me and where that $25 billion price tag starts to look almost inevitable. The explosion of non-human identities, or NHIs.
This is the high IQ investor's focus point. This isn't just another growth driver. This is the key secular trend that makes security spending completely non-discretionary.
We've moved so far beyond just securing human IT administrators.
So far beyond. Modern environments are just dominated by autonomous systems. We're talking about cloud-native apps, microservices, containers, serverless functions, APIs.
All talking to each other automatically.
Thousands of times per second. And every single one of those automated communications requires an authentication method. It requires a machine identity.
And the sheer volume of that completely destabilizes legacy security operations. I mean, the data we've seen suggests machine identities already outnumber human identities by a factor of 45 to 1.
And in some of the really cutting-edge cloud environments, our sources are saying that number is closer to 80 to 1.
That's just staggering.
That exponential growth curve translates directly into a forward revenue engine for CyberArk. This ratio is the forward revenue engine. Traditional security teams were trained to manage humans, maybe a few hundred accounts.
Now they're facing tens of thousands of machine identities.
And that's where the acute security problem arises. Because machines, they don't use simple passwords. They certainly don't use multi-factor authentication or biometrics.
They use cryptographic keys, API tokens, digital certificates.
Exactly. And those keys and certificates were historically managed by development teams, not security teams. And that created a massive, unguarded, and deeply technical attack surface.
A huge blind spot.
It was a massive blind spot. These credentials were often hard-coded directly into the application, or worse, just stored in insecure text files. So a bad actor gets in, and they can just move laterally by stealing a machine identity that often has totally unrestricted access.
Which is where CyberArk's secrets management solutions like Conjure come in.
Right. They ensure those machine identities are fetched dynamically from a secure vault at runtime, which completely eliminates that hard-coded security vulnerability.
So this isn't just a security problem anymore, it's an operational necessity that forces the spending. We've seen these regulatory and industrial pressures like shortening SSL/TLS certificate lifespans.
That's a perfect illustration of non-discretionary spending. It's a great example.
How so?
Well, the major browser vendors, for security and compliance reasons, are pushing certificate validity from 1 year down towards 90 days. Now, if an organization has even a few thousand certificates across its infrastructure,
Manually rotating them every 3 months is impossible.
it's humanly impossible. And if those certificates expire, the application goes down. You have an immediate public outage on your hands.
Which forces the CISO's hand.
It forces them to automate that entire certificate lifecycle management. So CyberArk, especially now with the Venafi acquisition, becomes the essential tool required to prevent operational paralysis and public downtime. They're selling uptime, not just security.
And that brings us squarely to the platformization imperative. This is what's driving all this massive M&A we're seeing.
This is the strategic meta trend.
All right.
CISOs are fundamentally exhausted. They have accumulated thousands of point solutions. We call it vendor sprawl.
They spend more time managing licenses than managing risks.
That's it. So the demand from them is deafening. They want integrated platforms that share data, context, and intelligence seamlessly under a single pane of glass.
And the market is responding with these huge, multi-billion-dollar consolidation deals. We saw Cisco buy Splunk, and now Palo Alto Networks buying CyberArk.
The implication for CyberArk here is just crucial. They saw this trend coming early.
So they built their own platform first.
Right. They aggressively built their own comprehensive identity security platform. They acquired key assets, and then they agreed to merge with a platform behemoth like PanW. They ensured their technology wouldn't just be some isolated point solution.
It becomes the core identity engine.
The foundational security layer within a guaranteed winning, future-proof platform. And that move secures their long-term relevance, even if it meant sacrificing their independence.
So the external market validated the need for CyberArk's platform, but that internal strategic pivot that validated its quality as an investment. Let's focus on that painful multi-year shift from the lumpy perpetual license model to the predictable recurring subscription model.
That transition was, it was a masterclass in execution, but it was not easy.
No.
The old model, perpetual licensing, it meant these massive upfront cash injections followed by smaller, lower margin maintenance fees, which is great for immediate GAAP revenue, but it creates volatility.
A lumpy revenue stream that makes valuation a nightmare.
It really does.
Yeah.
And volatility is just toxic to valuation multiples. In the SaaS world, predictability is priced at a premium. The new subscription model provides that high visibility, that stable annual recurring revenue, or ARR.
And it fosters deeper, longer-term customer relationships, which are way easier to upsell.
And the success of this transition is just undeniable when you look at the numbers. As of Q3 2025, their subscription ARR, which is the real measure of their cloud health, hit $1.158 billion.
Which is a phenomenal growth
A
rate.
phenomenal 57% year-over-year growth rate. They aren't just attracting new cloud-native customers, they are successfully migrating their massive, high-value, and incredibly complex existing customer base over.
That's the hard part.
That is the hard part. And critically, subscription revenue now accounts for 86% of the company's total ARR, which signals the transition is basically complete. It's mature. Management successfully navigated what people called the sauce chasm,
The period where the old revenue shrinks before the new subscription revenue fully kicks in?
and they came out the other side stronger. Which brings up a key insight for sophisticated investors, about the financial dynamics during one of these transitions. We often see tech companies report near-term GAAP losses when they do this.
And you have to understand why. It's not what it looks like on the surface.
It's not. The core issue is revenue recognition. Under the old model, you could book, say, 70, 100% of the deal as revenue the moment the license was sold. But under the subscription model, that same revenue is recognized ratably.
Spread out monthly or quarterly over the contract life?
Usually 3 to 5 years. So they sell a massive subscription, they get the cash up front, but the accounting rules say they have to spread the revenue recognition over years. This artificially depresses near-term GAAP profitability.
You look at their GAAP net loss and you might flinch.
But the whole point of the exercise is to maximize long-term free cash flow, which is exactly what they are successfully generating now. The accounting is more conservative, but the cash generation is stronger and much, much more stable.
Okay, so moving from the financial scaffolding to the operational architecture, CyberArk has successfully moved way beyond just the original vault that made them famous.
Oh, absolutely. They are now a fully integrated identity security platform with 4 really well-defined pillars.
The foundation is still core PAM.
It is, but it's evolved dramatically. It includes their Privileged Cloud SaaS offering, which simplifies deployment, and the Vendor Privileged Access Manager, or VPAM.
For securing third-party remote access, that's a huge breach vector.
A huge one. And crucially, they developed the Endpoint Privilege Manager, EPM, which is vital for stopping the initial stage of ransomware attacks.
Okay, explain EPM in simple terms for the listener. Why is it so important?
EPM just cuts off the easiest attack vector. When an employee clicks on a phishing link, right, the malicious payload often needs local administrator rights to execute or install itself.
So it can start encrypting files or moving laterally.
Exactly. EPM removes those local admin rights from standard users. It restricts their permissions to only what is absolutely necessary for their job. It's the ultimate implementation of the least privilege principle for the daily workforce.
And by taking away those admin rights,
You neutralize the most common ransomware tactic. You stop the attack before it can even get a foothold.
they also expanded into secrets management, which speaks directly to the developers and the cloud automation folks.
Yes, and this is crucial for that non-human identity challenge we talked about.
Yeah.
Historically, developers would hard-code database passwords or API keys directly into their source code.
Which is a gigantic, inexcusable security vulnerability.
It's a nightmare. So CyberArk's solution, Conjure, replaces those hard-coded secrets with secure API calls. At runtime, the application requests the credential it needs from the secure vault. This ensures the sensitive credentials are never exposed in the codebase.
It secures the entire software supply chain.
And it satisfies the security requirements of modern DevOps workflows, which
Right.
is key to adoption.
And then they made the, I think, very interesting decision to wade into the fiercely contested workforce identity space, competing directly with giants like Okta and Microsoft's Entra ID. Why take on that battle?
This is a niche calculated play. It's not a volume battle. They offer single sign-on, MFA, general user lifecycle management, but they are not going to beat Okta or Microsoft on market share for general SaaS access.
So what's the edge?
Their edge is a security-first approach that targets highly regulated industries, specifically banking, critical infrastructure, defense, and healthcare. These organizations prioritize security depth, session recording, and granular control over convenience or cost bundling.
So their strategy isn't to win the masses.
It's to win the most valuable, compliance-heavy accounts, the ones where a security failure means multi-million-dollar regulatory fines. That specific, high-stakes niche, that justifies the investment.
Now let's look at their astute capital allocation strategy, specifically the two major acquisitions that really transformed them from just a PAM leader into an identity security platform behemoth.
Management used M&A very strategically to wall off competitive threats and dramatically expand their total addressable market, their TAM. The most significant move was Venafi in October 2024 for about $1.54 billion.
Why was Venafi such a game changer?
Venafi was the missing piece. It was the key to achieving true market dominance in non-human identity. You see, CyberArk secured the access, the passwords, the tokens, the secrets. Venafi secured the connection.
The machine-to-machine trust layer.
Precisely.
Yeah.
By automating the lifecycle of digital certificates, PKI automation, and code signing keys. Machines need to access data, but they also need to trust that the machine they are connecting to is legitimate. Venafi ensured that critical layer of trust was managed and automated.
So by combining them,
CyberArk could secure the full lifecycle of all non-human identities. It cemented their leadership and expanded their estimated TAM by a full $10 billion. It was a brilliant move.
And the second acquisition, Zilla Security, addressed a critical governance and compliance gap.
Correct. Zilla Security, acquired in early 2025 for about $165 million, filled the gap in identity governance and administration, or IGA. Traditional IGA tools are notorious for being heavyweight, complex, slow to implement.
A huge pain for IT teams.
A huge pain. Zilla offered a lightweight SaaS native approach focused on automation and access reviews, so this acquisition closed the loop. CyberArk can now enforce least privilege with PAM, manage the secrets with Conjur and Venafi, and govern the permissions with Zilla.
Which provides the compliance workflows needed for audits.
Which, again, is mandatory spending for regulated industries.
So their operational and strategic playbook was just incredibly well executed. They managed the painful financial transition to SaaS while simultaneously acquiring the best-of-breed assets they needed to secure the most complex, fastest-growing area of the market.
It was a huge operational gamble, to be clear. I mean, executing a SaaS transition while integrating a massive acquisition like Venafi, that requires phenomenal operational discipline and foresight.
Most companies would just focus on one or the other.
They would. And that successful execution is what truly validates their premium valuation and the durability of their competitive advantage.
Okay, let's talk about that advantage.
What's fascinating here is it's the durability of their competitive advantage. For a critical investor, assessing a software company's quality really requires defining its economic moat. And CyberArk rests overwhelmingly on genuine structural switching costs.
And I would argue that PAM is probably the stickiest type of enterprise software there is, maybe even more than critical ERP or HR systems. If I'm a CIO, why is ripping out CyberArk so catastrophically difficult?
It comes down to two things: deep technical entanglement and the severity of the operational risk. It's like trying to replace the engine of an airplane mid-flight.
Not something you do lightly.
Not at all. The implementation of CyberArk requires integrating the vault, the master key storage, with thousands of critical assets. This isn't just installing an app on one server. It's touching every server, every database, every cloud function, every network device that holds sensitive data.
But the stickiest part is on the development side, right?
That's where it becomes almost impossible to remove. In a modern DevOps shop, application code is constantly being updated and deployed. That code is now programmed to fetch credentials via an API call to the CyberArk vault at runtime. So to replace CyberArk,
You have to rewrite the code.
you have to incur massive, debilitating technical debt. You have to identify every single piece of application logic across hundreds of microservices, rewrite the code to point to a new secrets manager, and re-architect administrative workflows across your entire infrastructure.
That sounds like an organizational project that could span years and hundreds of engineers.
It is. It's not just an expense. It risks operational paralysis. If you mess up the migration, you risk locking out your own administrative teams, your developers, your critical third-party vendors. That risk exposure is simply too high.
It outweighs any potential cost savings from a competitor.
Almost always. And the evidence of this is in their consistent market-leading renewal rates and extremely low churn, especially among their Global 2000 customers. Once they are integrated into a large, complex environment, they just become indispensable infrastructure.
So that structural stickiness, that's complemented by the second pillar of their moat, intangible assets. We're talking brand and trust.
And trust is everything in cybersecurity. CyberArk was the pioneer. They effectively created the PAM market over a decade ago. They are the market definer, the gold standard.
Then nobody gets fired for buying CyberArk effect.
That's it. In this risk-averse industry, that is a powerful psychological barrier. It's a massive barrier to entry that even superior technology can struggle to overcome.
And the industry analysts validate that market trust.
They do. CyberArk's consistent performance as a leader in the Gartner Magic Quadrant for Privileged Access Management. Achieving that top spot 7 consecutive times as of 2025. That just solidifies their status.
And that feeds the sales cycle.
It provides immediate validation to CISOs who are looking for vendor reliability.
Okay, let's turn to the competitive landscape, because this is where a critical investor really needs to weigh the long-term risk of market saturation. And we have to start with the elephant in the room. Microsoft and Entra ID.
Microsoft is the single most formidable competitor, period. Purely because of their ubiquitous bundling power.
The E5 licenses.
Exactly. They often just throw in basic PAM features into those massive E5 licensing agreements. And for small and mid-sized businesses, that good enough approach, combined with the convenience of a single vendor, it's often compelling.
So how does CyberArk maintain its moat against that kind of bundling force? We touched on it before, heterogeneity and depth.
That is the answer. CyberArk positions itself as the Switzerland of security. They are infrastructure agnostic. Microsoft's tools are inherently optimized for the Microsoft ecosystem, Azure, Windows Server, and so on.
But Global 2000 enterprises don't live in Microsoft-only world.
Not even close. They run complex legacy hybrid environments, 40% AWS, 30% Azure, 20% on-prem mainframes, maybe some Oracle databases. When you need granular control, detailed session recording, and advanced threat analytics for high-risk accounts that live outside the Microsoft sphere.
Like a mainframe administrator.
Like a mainframe admin. Entra ID just runs out of gas. CyberArk's ability to manage privilege across every legacy and modern asset, regardless of the vendor, is what wins them the deal in the Global 2000. They have superior depth where it counts the most.
What about Okta? They're the dominant leader in the broader workforce identity space.
Okta is very strong in access management for SaaS applications. But their attempts to move into deep PAM have been, let's say, less successful. Their offering is viewed as lightweight.
Good for a cloud-native startup, maybe?
Perfect for a cloud-native startup. But it lacks the robustness, the compliance features, and the deep integration necessary for legacy on-premise infrastructure and those complex regulated customer environments.
So CyberArk's historical dominance in legacy infrastructure acts as a fortress that Okta can't easily breach.
It does. And the Venafi acquisition gives CyberArk a new, decisive edge.
In machine identity.
An essential one. The combined CyberArk-Venafi platform has a massive proprietary lead in the non-human and machine identity space, which is rapidly becoming the largest piece of the identity market.
Yeah.
This is an area where Okta is comparatively weak and playing a distant catch-up game.
So the market is shifting under Okta's feet toward a complexity that CyberArk is already built for.
That's a great way to put it.
Finally, what about the pure-play PAM competitors like Beyond Trust and Delinea? How do they stack up on quality and scalability?
Beyond Trust is a strong, persistent rival. They're particularly strong in endpoint privilege management and remote access. However, the feedback from large enterprise system admins often points to an underlying issue. Beyond Trust often feels like a collection of separate tools that were acquired over time. It makes centralized management and data sharing feel clunky. CyberArk, through a lot of internal development and very thoughtful integration, has successfully built a more unified, highly scalable platform.
So it's better suited for the immense complexity of a Fortune 100 environment.
It is. And Delinea, which was formed by the merger of Thycotic and Centrify, seems to be chasing the mid-market on price.
They offer a strong value proposition there.
They do, especially for the mid-market where complexity is lower. But they suffer from significant integration debt. Merging Thycotic and Centrify was difficult, and user reviews frequently point to scalability issues in very large environments and a slower innovation pace as they resolve those internal integration challenges.
And in a platform war, that's a death sentence.
In a platform war, The vendor with the smoothest integration, the best scalability, and the highest velocity of innovation wins, and CyberArk's platform quality is clearly leading that race.
Okay, let's pivot to the quantitative evidence. This deep dive wouldn't be complete without looking at the financial evidence that validates this strategic moat. And this is a financially elite business, especially considering the massive business model transition they just pulled off.
The Q3 2025 data just confirms it. The transition has led to accelerating momentum and powerful operational leverage. Total revenue was $342.8 million.
Which is a robust 43% year-over-year growth. That's strong organic demand mixed with successful integration of their M&A.
And the recurring revenue engine is just running hot. Total annual recurring revenue hit $1.341 billion, growing 45% YoY. And critically, that net new ARR figure, $68 million,
Right.
up 16%, that signals they still have this sustained ability to land new logos,
And then more importantly, expand their footprint within the existing high-value customer base.
which capitalizes on those high switching costs we were just talking about.
And this brings us to the ultimate benchmark for a software company of this caliber, the Rule of 40.
The gold standard.
Explain the Rule of 40 for our listener and why it's so important for high-quality software valuation.
The Rule of 40 is simple, but it's really powerful. The percentage growth rate of a company's revenue plus its free cash flow margin percentage should equal or exceed 40. It shows a powerful balance between growth and profitability.
And companies that hit this mark are considered best of breed.
Best of breed. And CyberArk achieved Rule of 40 status for the full year 2024, which was ahead of management's own schedule.
And their current performance is pushing them into an even more elite tier.
They are operating at what many analysts are calling a Rule of 60 level. In Q1 2025, they reported an adjusted free cash flow margin of 30%. You combine that FCF margin with revenue growth that exceeds 30%, and it puts them firmly in the elite tier of software companies.
Alongside names like CrowdStrike and the company that's buying them, Palo Alto Networks.
Exactly. This margin performance confirms that the heavy investment phase needed to stabilize the SaaS model is over. They have powerful operating leverage now.
Meaning they're generating significantly more profit from each incremental dollar of revenue.
That's it. Non-GAAP operating margins expanded to 19% in Q3 2025, up from 15% in the prior year. That's a 400 basis point expansion in margin. It confirms the business is hitting an inflection point.
The fixed costs are being spread across a much larger recurring revenue base.
And it results in massive leverage on their sales and marketing spend. This financial maturity is exactly why they became such a prime acquisition target.
Okay, now we have to address the critical insight for the experienced investor. The distinction between GAAP and the cash flow reality. Because if you just look at the Q3 2025 headline numbers, the company reported a GAAP net loss.
A GAAP net loss of $50.4 million. And that can cause concern if you don't understand the underlying accounting.
Right. If you're only focused on reported earnings, you miss the story.
You miss the fact that this loss is almost entirely paper-based. It's driven by two primary non-cash charges: amortization of intangible assets from the recent acquisitions, like Venafi, and high stock-based compensation, or SBC.
Let's focus on stock-based compensation. Why is that so high, and why doesn't it bother sophisticated investors?
Well, SBC is a major expense for any fast-growing tech company, especially those competing for elite engineering talent in markets like Israel, where CyberArk's R&D base is strong.
It's a non-cash expense to attract and retain the best engineers.
It's issuing shares or options instead of cash, so it hits the GAAP books hard as an expense, driving down net income. But critically, it does not deplete the company's immediate bank account. It doesn't touch their cash reserves.
It's an expected, unavoidable expense in this sector.
So you look past it to the cash flow metrics.
And the contrast there is stark.
It's night and day. Despite that $50.4 million accounting loss, CyberArk generated robust cash flow. They reported $51.3 million in adjusted free cash flow and $50.7 million in cash flow from operations in Q3 2025.
So the core business is highly profitable, cash generative, and entirely self-funding.
Which is the defining marker of financial health and stability, especially when you're assessing the downside risk of a merger.
And their balance sheet provided the muscle for their strategic expansion.
A fortress. As of Q3 2025, they were sitting on $1.964 billion in cash and marketable securities. This massive liquidity allowed them to execute all-cash strategic acquisitions like Zilla without any shareholder dilution or taking on dangerous debt.
Their capital deployment was smart.
Very smart. Heavily focused on R&D and strategic M&A, which perfectly positioned them for this acquisition and ensure they entered the deal from a position of immense strength.
Okay, so let's get into that deal. The acquisition by Palo Alto Networks is the immediate defining event for the stock. If we were approaching this purely through a merger arbitrage lens, the deal mechanics and the downside risk protection are paramount.
Let's lay out the precise terms. CyberArk shareholders are set to receive $45 in cash plus 2.205 shares of Palo Alto Networks stock for each CyberArk share they hold.
Which implies a total deal value of roughly $25 billion.
Around there, yes.
And the market's confidence in this deal closing seems extremely high. It looks like a relatively safe arbitrage play.
It is. As of late December 2025, the trading spread, the difference between the trading price of CYBR and the implied offer value from PanW, has narrowed to about 1.1%.
That tight spread is the market basically screaming that it thinks the deal is a certainty.
It is. It's a low-yield opportunity for sure, but it's a highly protected one.
Okay, but let's challenge the valuation a bit. Palo Alto Networks paid $25 billion. Where do the sources suggest the market saw that price as maybe overpaying? And how does the standalone value truly support that number if the deal breaks?
That is the critical question. At $25 billion, the valuation is clearly expensive. It reflects a strategic premium for the irreplaceable nature of the asset. Analysts look at revenue multiples, and this deal commanded one of the highest in the sector.
So what justifies that price?
The strategic gap PanW absolutely needed to fill. Identity was the crucial missing fourth pillar in their platform strategy. They had networked with Strata, cloud with Prisma, and the SOC with Cortex.
But without a robust identity engine, their zero trust claims felt hollow.
They did. CyberArk plugs that gap with an undisputed, market-defining asset. The premium is the price you pay for immediate platform completeness and market leadership.
But the forward-looking driver, that seems to be entirely linked to the rise of agentic AI, which is moving from the lab to the enterprise incredibly quickly.
This is the visionary justification for the price. Palo Alto's CEO has explicitly linked this acquisition to securing the coming tidal wave of agentic AI. Autonomous AI agents. Whether they're executing tasks, accessing databases, or initiating code changes, they act as privileged users.
And they need identity controls that are far more complex than any human needs.
Far more granular, automated, and auditable. Securing these sophisticated non-human agents requires the deep, scalable capabilities of the combined CyberArk VNFI platform. The goal isn't just to compete with Microsoft today.
It's to build the unified super platform for autonomous enterprise computing tomorrow.
That's the vision.
Okay, in terms of the mechanics, what is the regulatory status? That's the primary remaining risk for deal failure.
The progress has been pretty smooth. The US FTC granted early termination back in September of 2025. CyberArk shareholders overwhelmingly approved the deal in November.
So the major remaining risks are in Europe and the UK.
Right. Specifically, the UK's Competition and Markets Authority, the CMA, and the EU's regulatory bodies. However, preliminary filings, for example in Austria, suggest the deal is likely to avoid a full Phase 2 European investigation.
Which would significantly reduce the likelihood of a major regulatory block.
Exactly. The market confidence is high because identity security is a highly fragmented market, and regulators typically look favorably upon platform consolidation as long as it doesn't create a monopoly.
Which brings us to the crucial question for the critical investor. What happens if the deal breaks? We need to understand the financial safety net.
The downside protection here is exceptional. If the deal fails due to regulatory issues, which is the most probable cause of failure, the merger agreement stipulates that Palo Alto Networks must pay CyberArk a massive $1 billion reverse termination fee.
$1 billion.
$1 billion. That cash injection serves as a colossal cushion against any immediate stock drop. It protects shareholder value almost instantly. Management negotiated a high fee specifically to address this downside risk.
And even if we discount that fee, what's the underlying standalone fair value of the business based on those strong fundamentals we talked about? The Rule of 40, high FCF.
Analyst consensus estimates the standalone fair value, what the stock would trade at if the M&A premium was shed, in the range of $415 to $480.
So even if it drops, the floor is very robust.
Incredibly robust. It's based on that achieved Rule of 40 status, continued 30% plus organic growth, and that established durable moat. The investor is protected by both a contractual payment and the underlying quality of the business itself.
All right, finally, for the investor who will hold Palo Alto Networks shares post-merger, what are the key risks? What are the things they need to worry about with integration and execution?
The key risks are entirely operational and cultural. First, integration risk is massive. You are trying to merge an aggressive, high-velocity, US-centric sales culture at Palo Alto with an engineering-centric, historically independent Israeli culture at CyberArk,
Talent retention is going to be critical.
especially that high-value R&D team in Israel. If key engineers leave, the long-term vision falters.
So what's the second risk?
Palo Alto already has a full plate. They're integrating other acquisitions components from IBM's Curadar assets, companies like Talon and Dig Security, adding CyberArk's complex, comprehensive portfolio. It just creates an enormous platform digestion burden.
So if the integration is clunky or slow,
It introduces friction for the existing customer base. And that's where the switching costs that protect CyberArk become a double-edged sword.
right, the stickiness only protects a happy customer.
Exactly. A highly frustrated customer facing operational friction from a poorly integrated platform might finally choose to undergo that painful migration just to escape the complexity.
And this is where competitors like Beyond Trust or Delinea will seize the opportunity.
They're already running active FUD campaigns. Fear, uncertainty, and doubt, arguing that CyberArk's tech will become shelfware inside the PAN-W conglomerate, slowing down innovation and service. Palo Alto needs a flawless integration to avoid that customer churn.
And finally, we have to acknowledge the persistent geopolitical risk.
We do. CyberArk maintains significant mission-critical R&D operations in Israel. While the company has shown phenomenal operational resilience, any major regional escalation could still impact productivity or investor sentiment toward the combined company.
Although the acquisition by a U.S. parent company does mitigate some of that financial perception risk.
It does, but the operational realities and the concentration of talent on the ground, they remain a factor to watch.
So this deep dive, it really presents two distinct high-quality investment paths. You have the safe, low-yield merger arbitrage play, protected by a billion-dollar breakup fee and strong fundamentals. Or you have entry into what is positioning itself to be the dominant global security platform, with all the complexity and opportunity that comes with holding Palo Alto Networks stock.
My final assessment is that CyberArk is a truly rare asset. It's a category pioneer that successfully executed a massive, painful business model transformation into a high-growth cloud innovator. And at the same time, it built a formidable platform that secures the most critical, fastest-growing part of the modern attack surface: identity.
The strategic logic of the acquisition is sound.
It's sound. And the moat, built on those structural switching costs and market trust, is exceptionally durable. It just makes this an excellent target for a strategic exit.
So what does this all mean for you, the critical investor focused on future scale?
I think you have to look beyond the immediate numbers.
The source material we reviewed states that machine identities already outnumber human identities by a staggering 45-to-1, and that ratio is driving mandatory security spending right now. If Palo Alto Networks is buying CyberArk primarily to secure the coming wave of agentic AI, truly autonomous systems that will be making life-altering decisions inside the enterprise, you have to consider the long-term exponential scale.
It changes everything.
What are the implications for software engineering talent, for IT staff training, and for enterprise security budgets when that ratio shifts from 45-to-1 to, say, 450-to-1? And those autonomous AI agents require identity controls that are 10 times more complex and granular than any human credentialing system we use today. That projected operational and security challenge is the real scale of the non-discretionary problem CyberArk just positioned itself via PAN-W to solve for the next decade.